Hello everyone, a very good evening to all of you. Welcome to part 2 of January 2025 RBI Circular MCQ class. We'll be starting our discussion in 1 or 2 minutes, okay? We'll be starting our discussion in 1 or 2 minutes. Okay guys, let's start our today's session, which is on January 2025. So in this particular video, we'll be discussing about the part 2 of RBI Circulars MCQs related to January 2025. In part 1, we discussed about a lot of MCQs yesterday. And this is the part 2. Let's quickly start. First, we'll be practicing the MCQs. And then we'll be having a good amount of discussion on the circulars as well, okay? So let's start with MCQs. The first is, many economies allowing the non-resident investor to access the debt market in an important way to attract stable foreign capital. So here the discussion is all about non-resident investor having access to the debt market of a country. Different investment routes and eligibility requirements are usually designed to balance the foreign participation with financial stability concern. The regulatory framework often define the types of instruments, the retention period, the reinvestment rules, the concentration limits of such investor. Which of the following most accurately reflect the regulatory strategy to promote the long-term foreign participation in a country's debt market? I repeat, which of the following accurately reflects regulatory strategy to promote long-term foreign participation in a country's debt market? So the options are in front of you. Please read the options and let me know in the comment section what do you feel is the correct one. The correct answer here is option C, creating a voluntary program where the investor agrees to retain the investment for a defined minimum period. Right? So there should be a lock-in criteria for country's debt market to promote the long-term foreign participation. There should be a lock-in criteria. Option C is correct. Next is, as part of the financial sector reforms, several jurisdictions allow unrestricted access to specific government securities to boost the foreign participation. Typically, certain categories of bonds are earmarked where the foreign investors are even non-resident individuals and can invest without facing any kind of quantitative restrictions. So there is no restriction based on the amount. What best categorizes a policy where the specific government bonds are made freely accessible to the foreign investors? What best describes a policy where specific government bonds are made freely accessible to the foreign investors? So what should be the correct answer as per your opinion? What should be the correct choice here? Option A is bonds are issued only in foreign currencies and available to select countries. Bonds have strict concentration and sectoral cap imposed by the foreign investors. Bonds must be swapped for domestic corporate bonds after a specified period. Option D, bond must be purchased through international banks under the bilateral treaties. Bonds are open for investment without any kind of quantitative limits and macro prudential restriction. Option E is the correct. This is the fully accessible route. We are talking about the fully accessible route, which removes the quantitative investment limit on certain designated government bonds here, right? Next is investment rules for FPI in the corporate debt market often emphasize maturity restrictions to ensure stability and avoid concentration of the risk in the short-term instruments. The regulatory policies define framework requirements and issue-wise exposure limit to manage the systemic risk. Which regulatory measure most effectively curb short-term speculation investments by the FPI in the corporate bonds? Which regulatory measure most effectively curbs the short-term speculation investment by FPI in the corporate bonds? What should be the correct choice here? What should be the correct answer here? Option A, allowing limited investment in the bonds with maturity below the prescribed minimum. Option B, setting a minimum residual maturity requirement for corporate bond investment. Option C, permitting the purchase of callable bonds with tenure less than 1 year. Option D, restricting all the investments limit on the corporate bonds during the financial crisis. And option E, offering special incentives for bonds with optional redemption clause within 1 year, and option B is correct here, setting a minimum residual maturity requirement for corporate bond investments, and that's what the circular was all about. What is the investment limit for FPI in outstanding stock of central government securities under the general route stated in the circular? Is it 2%, 6%, 10%, 15%, or is there no limit? The correct answer here is 6%. So FPI can now invest up to 6% of the outstanding stock of central government securities, excluding those under the fully accessible route as well. So which of the following regulations are included in the master directions non-resident investment in the debt instruments? So as of now, we are doing the MCQs based on the master direction, which is non-resident investment in debt instruments 2025. Which of the following regulations are included in the master directions? The correct answer here is all of the above. So FEMA, permissible capital account transactions, borrowing and lending and debt instruments all are mentioned in that particular circular. Right. Next is countries aiming to attract foreign capital often provide multiple channels through which non-resident investors can participate in the domestic debt market. These routes differ based on the regulatory conditions, flexibility of investments, and other type of instruments available. A well-defined framework ensures transparency, liquidity, and alignment with the broader economic goals. Which of the following is not an investment channel for non-resident investors in the Indian debt instruments? Is it general route? Is it FAR? Is it VRR, PSL route, or trading and settlement of sovereign green bonds? What is the correct choice here? And the correct choice here is option D, priority sector lending route. PSL route is not an investment channel for a non-resident investor in the Indian debt instrument market. Next is, in many jurisdictions, the foreign participation in the sub-sovereign debt market is carefully regulated to avoid the excessive external influence while enabling the capital inflow. Limits are often set based on the total outstanding stock of such securities to ensure that the balance, exposure, and systemic risk control. What is the maximum permissible limit for foreign portfolio investor to invest in the state government securities in India? So if the foreign portfolio investor wants to invest his or her money in the central government securities in India, then what is the maximum permissible limit here in this particular case. What's your opinion on this, guys? The correct choice here is option D, 2% of the outstanding stock, right? Next is to maintain the market transparency and prevent breaches of investment threshold. The regulatory framework often appoint dedicated institutions to track and monitor the foreign investors' activity in the debt market. These institutions play a key role in the real-time reporting and compliance enforcement across various investment routes. Which institution monitors the utilization of FPI investment limits in the government, central government, as well as state government securities? So, what is the name of the institution that monitors the utilization of FPI investment limit? कि कितना सेंट्रल गवर्नमेंट स्टेट गवर्नमेंट में इन्वेस्टमेंट हो चुका है, ये कौन सा इंस्टीट्यूशन मेजर करता है? So, what should be the correct choice here? The correct choice is CCIL, Clearing Corporation of India, right? So, CCIL is tracking the FPI investment limits, that too in the government security, to ensure the compliance, whether everything is there within the limits or things have crossed the limit. So, that compliance is checked by the CCIL, Clearing Corporation of India, right? Next is to channel the long-term foreign capital into the corporate sector while minimizing the market distortion. Regulators often set a upper ceiling on how much foreign investment investors can collectively invest in the corporate debt market. So here we are talking about the corporate debt instruments. This helps maintain a diversified investor base and mitigates the concentration risk. What is the prescribed investment limit for foreign portfolio investment investor in the Indian corporate bonds? So let's suppose if a FPI wants to make an investment in the Indian corporate bonds, what is the limit then in that case? What's the limit? And here the limit is 15% of the outstanding stock. To encourage the long-term participation from the foreign investors and reduce the volatility in the domestic market, some regulatory framework introduce special investment routes that come with mandatory holding period. Okay, mandatory holding period. So these routes are designed to attract stable capital inflows. So we are talking about the lock-in period here. While providing the regulatory exemption to the committed investor, the minimum retention period for investment made under the voluntary retention route. So if you are making an investment under the voluntary retention route, there will be a minimum retention period of investments that you need to follow. You cannot withdraw it before that, right? What is that period? What is that period? The correct choice here is option C, 3 years, right? So FPI must retain the investors under the investment under the VRR for a minimum period of 3 years here. Okay, that's the minimum. Under the VRR, FPI must invest at least what percentage of their committed portfolio size within 3 months. So whatever the commitment the FPI has made, what percentage of that will be required to be invested within 3 months? And the correct answer here is option C, 75%. They need to at least invest 75%. Right? Next is sustainable finance has emerged as a strategic priority for many countries aiming to meet the climate commitment. What is the primary objective of the scheme of trading and settlement of sovereign green bonds in the IFSA? Option A, encourage the domestic banking transaction in the green projects. Attract foreign investment in the infrastructure projects. Option C, to promote agencies in environmental friendly projects. Option D, to regulate the NBFC lending norms regarding the green finance. And option E, ensure credit default swaps are restricted in the environment friendly projects. What should be the correct choice here? The correct answer here is to attract the foreign investment in the infrastructure projects via sovereign green bonds. Which of the following statement is true regarding the short-term investment in the corporate debt securities by the FPI? Which of the following statement is true regarding the short-term investment in the corporate debt securities by the FPI? Here the correct answer is option E. FPI must invest in the corporate bonds with a minimum maturity of 1 year. Right? So if FPI is investing in the corporate bonds, you need to invest in at least a bond having a minimum maturity of 1 year. So FPIs cannot invest in the corporate bonds with a maturity of less than 1 year. Please do remember this particular circular is very, very important. In many emerging markets, FPIs are permitted to participate in the domestic debt market through defined investment routes. These routes outline the types of instruments that can be accessed, set investment limits as well. So eligibility criteria under such routes are often linked to the nature and maturity of the instrument, as well as the broader financial stability goals. Which of the following statement about the eligible instrument under the general route of the foreign investment in the Indian debt market is not true? So we need to identify which statement is not true here. Investment is permitted in the state government securities. Municipal bonds are considered under the state government security limits. Corporate bonds are eligible instrument under these routes. Central government securities excluding those under the fully accessible routes are allowed. Central government securities including those under the fully accessible routes are allowed here. So which of the following statement is not true, is false? The correct choice here is option E. Central government securities including those under the fully accessible route are allowed. This statement is false. This is not including, this is excluding. Short-term debt instruments often carry a higher investment, reinvestment, and liquidity risk. To avoid excessive foreign exposure in such instruments and ensure the market stability, the regulatory frameworks are designed. These frameworks help to maintain a balanced investment profile across longer tenures. Which of the following best represent the regulatory limit on short-term investments by FPI in the Indian debt securities? So what do you think is the correct choice here? Which of the following is the correct choice? The correct choice here is option B. FPI can invest 30% of their total portfolio in each category of less than 1 year government and corporate debt instruments. So option B here is the correct choice, right? To avoid excessive exposure from any single class of foreign investor, the regulatory authorities place concentration limits. So what are the concentration limits on the investment allocation? Now, these limits are varying depending on the investor profile. While long-term institutional investors typically allowed higher threshold due to their stable investment behavior compared to others, which of the following best describes the concentration limit applicable to the different classes of FPI in the Indian debt market? Concentration limit applicable to the different classes of FPI in the Indian debt market. Correct choice here is, guys, option C. Long term FPI may invest up to 15% of the total limit, while other FPIs are restricted to 10%. Next is, under the voluntary retention route for foreign portfolio investors, what is the minimum retention period prescribed? Under the VRR route of foreign portfolio investors, what is the minimum retention period that is prescribed for the investments? Minimum retention period. What is the minimum retention period here? The correct answer is 3 years is the minimum retention period. The long-term investment schemes often impose not just a minimum holding period, but also requirements on the initial deployment and maintenance of a significant portion of the committed funds. These measures are designed to discourage speculative flows and ensure sustained market participation. Which of the following correctly reflects the investment and retention requirement under the voluntary retention route for the FPI? The correct choice here is, guys, option B. FPI must invest at least 75% within 3 months and maintain at least 75% invested at all times. Next is to ensure efficient utilization of the allocated investment limits and discourage the parking of funds. Regulatory framework often mandates that proceeds received from the interest payments or security sales may be promptly reinvested. These rules help to maintain active market participation and prevent the circumvention of investment caps. Under the reinvestment rules of the FPI in Indian debt instruments, what happens if the coupon payments or sale proceeds are not reinvested within the prescribed time framework? If the coupon payments that the FPI has received or sale proceeds are not reinvested within the prescribed time framework. What should be the correct choice here? The correct choice here is option C. The unutilized proceeds will be considered as a fresh investment and subject to the available limits. Right, so these were some of the MCQs related to master direction RBI non-resident investment in the debt securities directions 2025. So if any non-resident is investing in the debt instruments in India, then definitely you need to follow these master directions, right? So they are issued under the Foreign Exchange Management Act and the RBI Act. Purpose: consolidate various rules and regulations directions regarding the non-resident investment in the debt instruments in India, right? And these two directions we can see that related to borrowing and lending, related to permissible capital account transaction, they all are impacted here, debt instruments and all, right? Applicability: all the authorized dealers category 1 bank must inform their clients about the same. The RBI allows foreign investors to invest in Indian debt instruments. So if I am a foreign investor, then definitely I can invest in the Indian debt instrument. There are 4 routes. First is the general route, another is the voluntary retention route, third is the fully accessible route, and fourth is the scheme of trading and settlement of sovereign green bonds here, right? If I talk about the general rule, then for investments in the government securities and corporate debt securities by FPI, subject to specified investment limits. So there are some limits and macro prudential limits as well, because it's a general route. So you will be subject to investment limit. You cannot kind of invest whatever you want. There are some limits. There are some macro prudential limits as well. If I talk about the voluntary retention rule, then they are free from certain macro prudential limits applicable to the FPI under the general route. So these macro prudential limits, certain macro prudential limits are not applicable in case of the voluntary retention route here. Fully accessible route, FAR, certain specified categories of government securities. So not all the government securities are eligible, only certain specified categories of central government securities without any restriction. So FPI can invest whatever amount he wants to invest in these particular central government securities, but they are specified. Scheme for trading and settlement of government sovereign green bonds. So eligible foreign investors in the International Financial Service Center can definitely invest in the sovereign green bonds that are issued by the central government here in this scheme. So 4 routes are there, right? 4 routes are there. If I talk about the general route, then there are certain limits. You can invest in the central government securities, you can invest in the state government, corporate bonds, municipality bonds. However, the municipality bonds are counted under the state government security limit only. So whatever the limit is applicable to the state government securities, municipal bonds will also be counted in the limit of those state government securities. Central government 6%, SG 2%, corporate bonds 15%. Sir, why municipal bond limit is not given separately? Because they are being counted under the limit of state government, which is 2%. So this is state government plus municipal bonds, both, right? It's inclusive of both. So you can have a look here. I have pasted the screenshot from the circular as well. Whatever I have written in summarized manner is there in the circular as well. Investment channels for non-resident investor. Short-term investment limit. Now FPI investing in the government securities having maturity less than 1 year. That's why it's called short-term. They must not exceed 30% of their total investment. So whatever the total investment is there, it should not exceed the 30% limit here. If I talk about corporate debt securities, then again 30% limit is applicable on this corporate debt securities as well as government securities, right? 30% is limit is there, not more than 30%. Investment channel for non-resident investors. So security wise limit is also there. Investment in any single government security must not exceed 30%. So it's there in securities as a whole plus single government securities also. Individual basis पे भी ये limit लगी हुई है. There is a concentration limit as well up to 15% in for the long term, and for others it's 10% concentration limit, so that the funds are not concentrated in some asset classes. Reinvestment of proceeds. So let's suppose if FPI is receiving the coupon payments or any sale proceeds, if any, then within 2 working days he needs to reinvest. If he doesn't reinvest, then it will exhaust the fresh limit availability. Within 2 working days में अगर invest नहीं किया तो नई limit के अंदर consume हो जाएगा. Let's suppose I received 100 rupees. So if I don't invest within 2 working days, this 100 rupee, after 2 working days I invested this 100 rupee, now my limit will get exhausted. अगर 2 दिन के अंदर अंदर कर देता तो limit exhaust नहीं होती, इसको पुराना investment ही माना जाता. Who will be monitoring? Obviously the Clearing Corporation of India, CCIL, will be tracking the usage of the investment limits for FPIs here. Voluntary retention rule. Now this encourages stable and long-term investment. Why? Because there is a minimum retention period requirement here. If a FPI is coming under the VRR route, then there is a minimum retention period requirement, right? So what is that limit? First, the investment limit is 2,50,000 crore, which is notified by the RBI. Allocation method is first come first serve basis or auctions as may be prescribed. This is subject to some exceptions as well. The retention period is minimum 3 years. FPI must invest at least 75% of the allocated amount within 3 months. So we have studied this thing in the MCQs as well, right? There was a question related to this limit in the MCQs as well. FPI must retain at least 75% of the investment at all the times. And these are the exit options that are available to the FPI. But the limits are very, very important for this particular circular. Next is fully accessible route, FAR. So allows unrestricted investment in specific government bonds. So if there are some specific government bonds stated by the government, you can unrestrictedly invest as much as you want, right? FPI can invest as much as he or she wants in these specified government bonds. So this is fully accessible route, right? This is voluntary retention route. So there is a word retention. That means you need to retain it for a certain amount of time. Okay. Next is trading and settlement of sovereign green bonds. So the objective is foreign investment in the sovereign green bonds issued by the government. What are green bonds? Basically, they are investing the money, they are raising the finance for environmental sustainable projects. It can be renewable energy, it can be clean transportation, anyone. Water management system, right? If I talk about the corporate debt investment rules, then minimum residual period, this is quite important, right? You need to remember this limit. FPI can only invest in the corporate bonds with a minimum maturity of 1 year. The minimum maturity should be 1 year, not less than that. This is only applicable for the corporate bonds, for the corporate organizations like Ambani, Adani, right? Then there are some investment limits as well, that FPI investment must not exceed 50% of any single corporate bond issue and like that. Concentration limits we already studied in the MCQ, right? So I have summarized everything in the key takeaways as well, and please read this particular circular very well. This is very, very important from your examination perspective, right? This is a very straight question. Modern regulatory system focus heavily on the consumer protection, ensuring smooth succession of the assets in case of depositors' demise. Now, financial accounts like saving deposits, lockers, and security holding is considered crucial to minimize the legal disputes and protect the families from the hardship. Which of the following action is most aligned with enhancing the financial security of the depositor's family? So options are in front of you. Let me know in the comment section what should be the correct choice here. What do you feel will be the most apt option in this particular question? It's very, very simple. The circular is not so important, but yeah, I have drafted 1 or 2 MCQs around it. What is important, I'll definitely tell you. One question from this particular circular is important, so we'll be discussing about that as well. The correct choice here is option B. That's quite straight, mandating the depositor designate nominee, right? So, sir, what's new in this particular circular? Nothing new. It's a straight circular. But this particular question can be important from this circular. In the financial sector, institutions are expected to implement mechanism that periodically assess the key customer service metrics, such as nomination coverage. The board often delegate these responsibility to a specialized committee to ensure proper oversight, accountability, and timely reporting to the regulators. Which committee is responsible for periodically reviewing the achievement of nomination coverage in the banks as well as financial institutions? So this circular stated talked about a particular committee. This particular question can be important from this circular. The correct answer here is customer service committee, right? So the correct answer is not nomination and review committee, it's customer service committee. Okay. To enhance the real time tracking, regulatory bodies often introduce digital platforms that allow the financial institutions to report critical data, such as work status, fraud, and risk indicator. Now, these tools serve as a backbone of modern regulatory oversight. Which of the following statement best describe the purpose of the DAKSH portal launched by the RBI? Have you guys heard about the DAKSH portal? I hope everyone has heard about this particular portal. So DAKSH portal is a supervisory system for compliance, fraud, and risk reporting here, right? So the coverage of customer under the nomination facility, we discussed about the nomination facility, and the important thing I personally feel from this particular circular is customer service committee, right? And that shall be reported by the AC in the Reserve Bank of India's DAKSH portal on a quarterly basis, right? Supervised entities will be reporting that thing in the on the DAKSH portal on quarterly basis. Entities that engage in sending commercial messages such as promotional SMS, telemarketing calls are required to follow strict regulations and compliance guidelines. This is done to ensure customer privacy, regulate commercial communication, and prevent the misuse of customer data under typical regulatory framework. Which of the following practice is required for sending promotional financial communication? The correct choice here is option B, obtaining digital consent from the customers through verified OTP system. Increasing dependence on the mobile phones for banking and financial transactions has made mobile numbers critical identifiers. Regulatory agencies worldwide are concerned about the misuse of these numbers for financial frauds through techniques like SIM swapping, phishing calls, spoofed SMS messages, and have introduced protective measures accordingly. Which of the following is a regulatory measure to mitigate the financial frauds involving the mobile numbers? The correct choice here is option B, publishing a revocation list of disconnected or fraud linked mobile numbers, right? So this is from the circular of prevention of financial frauds penetrated using the voice calls and SMS, regulatory prescription, and institutional safeguard, right? Not so important, but yeah, you can remember you can have just a quick reading of this particular circular for a overview of it, right? Asset reconstruction companies play a crucial role in resolving the stressed asset in the banking system. To ensure transparency and proper conduct, these entities are governed under the specific laws that provide a legal framework for asset recovery activities, under which act the asset reconstruction companies in India are regulated. A very simple question: if you know about asset reconstruction companies a bit, definitely you can answer it. The correct choice here is Sarfazi Act, option B. Right? To enable the recovery of bad loans and provide liquidity to the banking system, the asset reconstruction companies often purchase the non-performing assets of a bank. That's the basic business model of a asset reconstruction company. In exchange, they issue financial instrument to qualified investors that represent an undivided right in the underlying distressed asset. What do ARC issue to investors after acquiring the bad loans from the bank? The correct answer here is option Z, security receipts. Right? Asset reconstruction company play a vital role in helping the banks manage their non-performing assets by purchasing the bad loans and trying to recover value through various resolution methods. The regulatory framework ensures transparency, fairness in settlement procedure, and valuation of distressed asset. Which of the following is a regulatory safeguard related to the settlement of dues by the asset reconstruction company? Which of the following is a regulatory safeguard related to settlement of dues by the asset reconstruction company? The correct answer here is mandating that the settlement valuation must consider the realizable value of the security. If you guys have read that particular circular in detail, definitely you will be able to answer it. Asset reconstruction companies are governed by comprehensive framework to ensure fair settlement of borrower dues. For large exposure involving the professionals and ensuring a multi-layered approval process, enhances the governance and reduces the conflict of interest. Which of the following practices would best strengthen the governance in the large account settlements by the ARC? Which of the following practices would best strengthen the governance in the large settlement by ARCs? The correct answer here is option C, setting up an independent advisory committee for evaluating the high value settlements. When dealing with asset settlements involving smaller loan amounts, regulatory framework often prescribe conflict of interest safeguard. To maintain integrity in the decision making, individuals previously involved in the asset acquisition are barred from participating in the settlement approval. Reporting ensures transparency to higher authorities in the case of settlement of accounts with principal amount up to 1 crore. Not more than 1 crore, we are talking about up to 1 crore. What key governance measure must the ARC must follow here? The correct answer is submit a quarterly report on such settlement to the board or a designated committee. So we discussed MCQs related to the guidelines on settlement of dues of borrowers by asset reconstruction company, right? What is the asset reconstruction company? Basically, it's a company which is involved in buying the bad loans. Let's suppose a bank is having some NPAs, bad loans, right? So ARC is buying these NPAs for a price. Obviously, let's suppose the NPAs are worth 100 crores. ARC is buying these NPAs in, let's suppose, 50 crore. Why? Because they are NPAs, so definitely the bank will be giving them at a discounted price. Now, where the money comes from? So there are investors who are investing in the asset reconstruction company, so they are putting their money, and in return ARC is giving the security receipts, just like securities, just like shares. So the investors are having a vested interest in these NPAs because of the security receipts here, right? That's what a asset reconstruction company business is all about, right? Now ARCs are regulated by the Reserve Bank of India under the SARFAESI Act, securitization and reconstruction of financial assets and enforcement of security interest, right? So in the January 2025, RBI revised the guidelines related to ARCs. The key highlights are ARCs now need to have a board approved settlement policy. Now you cannot just directly settle the things, you need to have a board approved settlement policy defining criteria related to the settlement of borrower dues. So if the borrowers are not paying the money, so there are settlement criteria that needs to be already approved by a board. That means you need to have a policy in place. Eligibility cutoff dates for one-time settlement. If you are doing a one-time settlement, then eligibility cutoff date should be there. Acceptable concessions for different exposure categories. What concessions you are providing for different categories should be upfront decided in that policy. Methods to determine the realizable value of security, right? Assessment before the settlement. Settlement should be only pursued after exhausting all the recovery avenues. अगर आपने बाकी के सारे recovery avenues try कर लिए, then you can opt for settlement. Otherwise, you need to first exhaust all the options of recovery. Okay. Valuation consistency, again an important point. The net present value of the settlement should not be less than the realizable value of the underlying securities. Let's suppose the loans are worth 2 crore and you are having securities worth rupees 1 crore. So the settlement should not be less than 1 crore, obviously, because the realizable value of the securities in itself is 1 crore. अरे आप वो सिक्योरिटी बेच के ही पैसा वापस ले लो ना, फिर सेटल, ये कौन सा सेटलमेंट है? व्हाट काइंड ऑफ सेटलमेंट इज दिस, राइट? आप तो सिक्योरिटीज बेच के पैसा ले लो वापस 1 करोड़ रुपी. सो एटलीस्ट द सेटलमेंट शुड बी not less than the realizable value, the net realizable value of the underlying securities. Otherwise, there is no point of making the settlement, right? If the outstanding principal amount exceeds 1 crore rupee, then an independent advisory committee should be there, consisting of professionals that do have technical, financial, legal expertise, right? At least 2 independent directors should also be part of that independent advisory committee. In case of the smaller accounts, let's suppose if I talk about less than 1 crore, then individuals that are involved in the asset reconstruction, asset acquisition, should not be participate in the settlement approval process. Otherwise, this will be a kind of conflict of interest. There should be segregation of duty. मान लो मैं acquire करने गया था asset, right? अब मैं ही उसका settlement भी करवा रहा हूँ, so I can definitely be involved in a kind of fraud, right? Or a conflicting situation. So इंडिविजुअल ऐसा जिसने एसेट को एक्वायर किया हो, he cannot be part of the settlement process, and there will be quarterly reports, right? Next is to maintain regulatory consistency and strengthen the oversight of housing finance. How many authorities? Periodically harmonize the guidelines across different categories of financial companies. Housing finance companies are often required to align with the broader regulatory framework applicable to the non-banking financial companies to ensure uniformity. What is the best statement that describe a typical regulatory approach to streamline the housing finance regulations here? The correct answer here is, guys, option A, applying standardized private placement norms across NBFCs and HFCs. So basically, there used to be a circular for NBFCs, and in this particular circular, it's been stated that mutatis mutandis apply to the HFCs as well. That means as it is applicable for the housing finance companies as well. Private placement of non-convertible debentures with maturity period of more than 1 year by HFCs. What are housing finance companies? Basically, they are non-banking financial companies that provide housing loans to individuals and businesses for the purchasing, construction, and renovation of their houses, right? So they are again regulated by RBI, and earlier they used to be regulated by the National Housing Bank, right? So we were having directions related to the NBFCs that will now also apply to the HFCs. What is non-convertible debenture? Such a kind of debt instrument that you cannot convert it into shares. Let's suppose I issued you debentures. You paid me money, right? I issued you debentures, you gave me 1 lakh rupees. Now at the time of repayment, I asked you that I won't be paying you 1 lakh rupees back, but I will take my debentures from you and I'll give you my equity shares instead of 1 lakh rupees. I'll give you the consideration in the equity share capital of my company, but not in the actual money, not in the actual cash form. That's called convertible debentures. When your debentures don't have such a kind of option, they are non-convertible debentures. You cannot convert that into shares, right? So these guidelines related to the private placement. What do you mean by private placement? Where we privately place our securities to few selected individuals or group, right? That's not an IPO. That's a private placement, right? So these guidelines used to be there for NBFCs. Now they will be applicable mutatis mutandis to HFCs. What is mutatis mutandis? Basically, it means as it is. In the legal language, we call it as mutatis mutandis. That means as it is applicable to the HFCs as well, right? Payment and settlement system are crucial to a country's financial stability. Regulatory frameworks are designed to penalize serious breaches and non-compliance and operational lapses by entities that handle such system. Ensuring the trust and transparency in the digital financial ecosystem in the context of enforcing under the payment system laws, which action is most aligned with the regulatory principles here. So options are in front of you. Do let me know in the comment section what is the correct choice here. The correct answer here is, guys, publishing penalty actions to enhance the transparency accountability, right? Acha, what is the nature of penalty? Basically, in the regulatory enforcement framework, penalties are calculated considering the factors such as the benefits gained from the non-compliance, harm caused to the others, seriousness, contravention, and all, right? Under the revised RBI framework, what is the maximum monetary penalty that can be imposed for the contravention under the Payment and Settlement Act 2007? What is the amount of penalty here? The correct answer here is, guys, option B, 10 lakh or twice the amount involved, whichever is higher. So this particular framework is for imposing the monetary monetary penalty and compounding of offenses under the Payment and Settlement System Act. So if there is any kind of contravention of the Payment and Settlement System Act, like operating a payment system without proper authorization from the regulatory body, deliberately providing false information or omitting the crucial details, or failing to submit the requirement statement, information in returns or documents, right? So there are designated authorities that are given, and the process is all given here, right? Yeah, okay. So here is the determination of the penalty amount that we talked about, right? So the penalty shall not exceed 10 lakh or twice the amount involved, whichever is higher, right? And for the ongoing contravention, an additional penalty of 25,000 per day can be imposed, right? So you can remember this limit and have an overview of the circular as well. So that's all from my end, guys. Thank you so much for watching today's video. See you soon in the coming classes. Bye bye. Take care. See you soon.